Audio Jungle. Audio Jungle.
How Warren Buffett selects stocks to invest in. You've probably heard the popular statement, शेयर मार्केट में इन्वेस्ट करना हर किसी का काम नहीं, and perhaps not knowing enough about these companies, balance sheets, mutual funds, REITs and some complex investing strategies. With those 20,000 rupees in your pocket isn't that easy. What if we tell you that some of the big names like Warren Buffett, Charlie Munger, Michael Burry, Rakesh Jhunjhunwala and Mohnish Pabrai, all of them had to go through similar circumstances? You guessed it right. In this video, we are going to uncover the stock selecting process employed by legendary investors. And by the end of this video, you're gonna know Warren Buffett's value investing strategy and how it can help select stocks in the Indian investing game. What are those key factors Warren Buffett considers before selecting a stock? How can we invest the Warren Buffett way in the Indian stock market? Now, before we start throwing those fancy and complex investing strategies and manuals your way, we want you guys to consider yourself as a beginner, just figuring out how to invest in stocks the best way. If you want to invest like Warren Buffett, you don't need to think like someone from Mars. It's pretty simple, and many new investors are marveling at the simplicity of the Oracle of Omaha's investing strategies. Let's dive right into them. Number 1. Always look for a margin of safety. Rule number 1. Don't lose your money. Rule number 2. Always follow rule number 1. Simple as that. And how you're gonna follow these rules? Through the margin of safety. These 3 words should form the core of any investor out there. Benjamin Graham, the lifelong mentor of the legendary Warren Buffett, introduced this term to the investing world. Now everyone wants to buy shares at reasonable prices. No one lasts to pay 1,000 rupees for a share worth 500. When due to certain circumstances, the share prices plunge, investors always look to speculate and exit. According to Buffett, that's the time when you need to swing your bat the hardest because the stocks are available at a sale price. For example, the stock market was in a crisis during COVID and it had a huge toll on the Indian stock market. In March 2021, IHS Markit India Manufacturing Purchasing Managers Index PMI slipped to a 7-month low of 55.4 from 57.5 in February 2021. Similarly, the blue chip NSE Nifty 50 index sank 12.98% and even the S&P BSE Sensex plunged down 13.15%. The Nifty PSU Bank Index, which tracks state-owned lenders, slumped 12.69%, while the Nifty Private Bank Index plunged 17.88% to a near 4-year closing low. And when we come towards the banking industry, the lender HFDC Limited suffered the worst. To put a long story short, everyone was looking to get out of the share market. According to Warren Buffett, this is when you hit big. Buy low, folks, and then wait till the market restores its value. The margin of safety is nothing but the principle of buying a share when its share price is significantly below its intrinsic value. This is a strategy that helps you invest at the right time and ensure that the scope of losses is low. Understanding the intrinsic values of stocks. For example, let us just suppose that the share price of Reliance Industries is somewhat at 2,000 rupees. But when you analyze the company and the business model, you find out that the share price should be somewhat at 2,500 rupees. So the share is undervalued, to say the least. The intrinsic value of a stock is the true value of that stock. And as Warren Buffett puts it, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Warren Buffett's ultimate goal is to always pay less than what the company is worth, or to put it the other way, always pay less than the intrinsic value of a stock. Number 2, don't invest in junk, always go for quality stocks. You'll never see Buffett putting his money into some struggling businesses, regardless of how cheap they are. If you ask us what's the best thing every beginner investor should learn from Warren Buffett, then this quote does it all. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Simply buy quality businesses at reasonable prices. Be fearful when others are greedy and be greedy when others are fearful. Number 3, select stocks with an economic moat. Another one of the famous terms used by Warren Buffett when it comes to selecting stocks to invest in is that of an economic moat. To put it simply, and to cut all the fancy stock market jargon, it simply refers to a certain competitive advantage that is held by companies over their rivals. Let's just take an example. Suppose you've decided to start a lemonade business in the suburbs of, let's say, Hyderabad, and you're trying to compete with the neighboring lemonade stalls. After countless sleepless nights and thoughtful days, you have finally researched that if you buy your lemonade in bulk once in a week instead of once every morning, you can cut down your expenses by 35%, allowing you to offer better rates than your rivals. Your low prices simply attracted more customers to your stall, and you outwitted your rivals. You developed a moat by gaining a competitive advantage. Now, similarly, when we talk about the New York Stock Exchange, for instance, Coca-Cola has a very strong moat over other companies. It is one of the most popular soda brands throughout the world, and its syrup formulas are protected. You can tell it whether your eyes closed that Coke is the best, most consumed beverage throughout the world. Similarly, Google is another company with an economic moat, a competitive advantage, over other companies of the same type. Its proprietary search algorithm and the extensive database give the company a clear advantage over new and existing competition. With 67% of the search engine market share and climbing, it has an immense stronghold over anyone attempting to produce a substitute. Now a question arises, how do we know if a company has an economic moat? The answer to this question is straightforward. To measure the moat, simply look at the profit margins. If a business has no moat, it will let other competitors affect its profits, and hence lower the share price altogether. You wouldn't be able to tell with ease regarding the best company in that area particular niche. This will cause the profits of that company to fall significantly. On the other hand, if a firm is able to withstand all of the competition and is still able to expand its profit base without undergoing excess debt, this characteristic represents a strong moat. When we talk about such moat companies in the Indian investing landscape, then some good examples of such stocks can be stocks like Asian Paints, Shriek Cements, Tata Consultancy Services, Avenue Supermarts, Titan, and so on. You get the idea. Titan has been one of the greatest wealth creators in modern times. It is also responsible for creating a major chunk of the big bull Rakesh Jhunjhunwala's wealth. Titan, founded in 1984, is part of the Tata Group. And similarly, we have Asian Paints, which is one of the most obvious stocks on this list. The company was founded in 1942 and is engaged in the manufacturing, selling and distribution of paints, coatings, products related to home decor, bath fittings, and providing of related services. Number 4. Company performance, company debt, and some key factors to consider before investing. Has the company offered good returns to its investors in the past? Are they offering good returns on equity, ROE? The buffet always looks for companies with great returns on investments. Now, the return on equities or ROE can be calculated easily. You can always use your mathematical skills and divide net income by shareholders' equity to determine the ROE of a company. The debt to equity ratio is another key aspect you need to view before investing your money in a business. Buffett prefers to see a small amount of debt so that earnings growth is being generated from shareholders' equity as opposed to borrowed money. To calculate the DE ratio, you need to divide the total liabilities by the shareholders' equity. Number 5. Don't follow the crowd. People will always come up with ideas like, भैया ये startup बहुत कमाल लग रहा है, मुफ्त पैसा है, invest कर दे. And this is where most of the beginners get destroyed. Don't buy certain stocks just because everyone else is, but also do not aim to always be a contrarian and sell the stocks that everyone else is buying. As Buffett does, the best way to invest is to ignore the crowd entirely and focus on finding value on your own. The majority is not always right. He also says the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. So that was all for today, folks. Do you want us to make a separate video on the importance of moats? How are you guys planning to implement these key points in your investing journey? And moreover, let us know about your investing decisions in the comment section below. Make sure you press the like and subscribe button, and we'll see you guys in the next video.